Rob's Child here with Security Analysis. Chapter 29, The Dividend Factor in Common Stock Analysis. Nothing I say is investment advice. I have no intention to replace the contents of this chapter, but to review it, discuss it, open it up for a conversation, for a dialogue. I would greatly appreciate any comments about this chapter in the section below. This chapter is a behemoth of a chapter. It has so much information to unpack. This is the most valuable chapter to me so far. Chapter 29. He goes into detail about explaining mostly about what a company should be doing regarding dividends. Should they be paying it out, or should they be keeping the money? And it really boils down to one point that he repeats ad infinitum, which is at the very end. Basically, he reiterates it again, that stockholders basically really should have the right to decide if any earnings of a company are retained by the company or not, and that should be in the hands of the stockholders, not in the hands of management, not in the hands of the corporation. And the corporation shouldn't have like an overall policy that they simply pay out a certain amount, keep a certain amount. So there's a lot of detail going into this. Reading through the chapter, he makes a lot of very good points. There's a bit of history involved with this. If I'm going to recommend reading one chapter of this book, I think so far from the beginning until chapter 29, this is like the chapter to read so far, because it gave a perspective that just really gets you to understand what a dividend really means and what not paying a dividend really means. So let's go through my notes, and I'm going to be discussing various parts of this chapter. So to begin, we say that the dividend is important and equally unimportant, that both views are valid. Certainly when it comes to growth stocks, like, imagine, the beginning of the railroads. Okay, before there were railroads, they needed a lot of investment. The more that was invested, the more the companies were able to earn. Obviously, it wouldn't be smart for the railroad companies to immediately start paying stockholders earnings while there were still so many more railroads to be built. But, as soon as the market share has been filled up, it's like, that's the time for obvious dividends. And then, a lot of areas it can be ambiguous. Like, you don't know how big a certain market's going to be, and in those cases, you might want a higher dividend. But the point is, so that's his first point, is that dividends are important, equally unimportant. They're both valid. And so, and the discussion leads on to the question, what's the goal here? Are you a partner in this company that gets paid to own the company? Makes sense, right? Or are you there just to have a marketable security? So he makes a differentiation there. On page 374, he goes over 3 reasons to withhold the dividend. First being strengthening the financials, which is like increasing the working capital. I believe that's what he means. And then increase the productive capacity, or to reduce overcapitalization. So pay back, if they're holding too much debt, pay off some of that longer term debt that maybe we don't need all that debt. And so those are reasons to withhold a dividend, good reasons. The three main reasons that you would hold a dividend. Now, unfortunately, from what I gather from this chapter and from what I've seen in companies myself, it doesn't seem like earnings are often retained just for those three reasons. And we'll get into that. So then he goes on and explains a long thought process on how a company should pay a dividend, including, how to help the company stay stable, how much of it should be paid. He goes into another section that if you have two comparable companies, like they're copies of each other, okay? They're the same size, they produce the same amount of stuff, they do all the exact same thing. So that's when we get to this paradox that he talks about later in the chapter, that typically, at least at this time, if you have a company that's paying more of its earnings as a dividend, the stock price actually goes up. So you have a company that's more valued because they're paying out more. And the ironic thing about that is that the company that's making just as much money, withholding that money, is not considered as valuable by the market, even though they have more money. They literally have more assets. Like, they're holding on to that money. So you would think, like, okay, they have to be equal. But if you pay out more, you tend to be worth more. These days, I don't know if that applies necessarily, especially like as much, considering especially how many stocks out there actually pay pretty darn big dividends. But like, from my perspective, it seems as of right now, we might be changing into a different cycle, as what happened after the Great Depression. But as of right now, it seems that the bigger the dividend, the lower the cost of the shares are overall. When it comes to so many industries, so many different types of stocks, especially like regarding specifically right now, dry bulk shipping, tobacco, and cell phone service companies are paying like 8% right now. So that's really high. And that's the thing. We might be going into a revaluation where, companies are making plenty of money and paying out plenty of money. We may shift into a period where those companies are more valued. Certainly, Lynn Alden believes that the 2020s, we're in year 3 of the 2020s. She believes this whole decade we're going to see that we're going to see sort of a revaluation of, we're finally going to get out of this, hyper growth idea that everybody just invests everything in growth, and these companies that keep making money and keep paying it out will finally become readjusted to a more fair price. I mean, you look on markets right now, like I said, it seems like we're in a period right now in 2023 where large dividend stocks are not worth a lot more; they're worth less. So I find that very interesting. Makes me think that Graham might really like to be involved with markets at this time. I have a feeling he would be buying up a lot of undervalued value stocks like a madman right now. So he goes on to mention that low dividend paying companies, when they do so to try to protect themselves, from a downturn in earnings, rainy day fund kind of a thing, that it doesn't typically actually pan out that way. He really criticizes companies that, this whole chapter, he criticizes companies that don't pay enough dividend out very strongly. He looks at corporations. It's obvious reading this whole chapter. He looks at corporations as, the management and essentially the management having too much control over the earnings. Not distributing them to the shareholders. It's like, that money just tends to disappear is basically what it kind of boils down to. An additional point that is made about money that's not being paid out to the shareholders that I've never thought about before, and that I think is very important to understand, is that when you're not getting that money, that's money that corporation has instead of you having it. Now, if you have the money, let's say you just put it in a money market account right now, yielding 4 or 5%, something like that, and versus them just having that money, first of all, you're not gaining that interest on that money directly. You have to depend on them to make more money with that money. Now, here's the thing. If they're always holding on to, let's say, even 50% of, or even 30%, like he says in this chapter, let's say the company only holds on to 30% of the earnings. Is that amount of money, are they going to, use that money enough to properly increase the production of their company? Are you going to see, a 30% increase of earnings by the company in the next year because of that retention of that 30%? Are you going to see that for real? Or is that just, gone with the wind? And he criticizes companies for, basically, having the board be in cahoots basically with the upper management and giving themselves bonuses and salaries. And he doesn't like that. He's like, if I'm an owner of a company, I'm the guy that's supposed to get paid here. That's the point. Of course, you have to reward management for making money with your money, but and so, well, let's just move on to the next point. One other thing I wanted to mention about this is that another bad thing that can happen, additional to those things with retaining too much earnings, is that the company's intending, and he talks about this in the chapter, the company is trying to expand its size. It's trying to, invest more into itself, make more ding-dongs, let's say. I heard another YouTuber talking about ding-dongs, so that was funny. Let's say they just want to make more and more and more ding-dongs, and, they're retaining earnings. So they're like, hey, look, guys, we're making more and more ding-dongs. Well, what if the world doesn't want any more ding-dongs and you keep growing? And, there's a warning with that. So what can happen is you can have management get all excited about growing their business, making it look bigger, turning it into a behemoth. And if there's not enough demand for that production, then you have overproduction. You have management basically trying to get as much production as possible to say, well, we should have higher salaries for the upper management. The company's bigger now, we have more stuff to manage, and so there's a little bit of problems that can come from that too. Also, another point he makes with decisions of distributing or not distributing dividends can lead to a manipulation of the stock price to go up or down. And this can happen to directly benefit insiders. And so all of this stuff I found to be highly, highly interesting. So just to not skip over too many of my notes, I mentioned here retaining earnings power generally does not increase with accumulated withholdings. And so that's the thing. If the company is going to retain earnings and not pay the shareholders, what are you guys doing with that money? Where is it going? Is it making me more money? Like, why aren't you just paying me that money? I was going to bring up another point at the end of the chapter. I want to mention it now. This is partly like why I actually question the buybacks too. You know, a lot of people today say, oh, well, you know, I'm in a better tax situation if the company just does buybacks, because what it does is it decreases the number of shares and therefore increases their value. Okay, fair enough. However, where are those shares going? They're going off the market. They're going into the company. So now it increases the potential. Again, it increases potential greater dividends in the future. But again, they're not actually paying those out. The money's not going out of the company. To me, a buyback is no different than really retaining earnings, because I don't see a difference there. I don't actually see a difference there. You know, it's just another way for the company to not pay out, and I think that's baloney. I mean, I'm getting a little huffed up on the gram ideas about like pay me my dividend idea. Let's move on point to point. I'm excited to get to some of these points in this chapter. So we have one point here talking about withholding dividends can benefit large holders, which are often insiders or directors, by reducing taxes. You know, when dividends come in and you're in the tax bracket today where you have to pay 40% of that income, you know, it's not beneficial to you. So for the big holders, so you know, it makes me realize too, like, it's the small stockholder, the guy that isn't in the 40% tax bracket, that will benefit more from having dividends paid than the big owner. And so that's interesting. And Graham's on the side of the little guy very clearly throughout all of this, not, you know, including that reasoning. He mentions again here about profit and loss situation where there's a withholding and then the money essentially ends up disappearing. I think that's what he's going on there. I need to understand this profit and loss scenario better. But he says, I think he talked about it earlier in the book and mentions it again here. But yeah, it's all the same idea. And then, he makes the point here. So this was a surprising thing to learn about. In 1940s, he says abroad, in certain countries, there are countries that have all of their earnings paid out as dividends. And if a company wants to expand, they sell more stock. Now, doesn't that make more sense? You're you're McDonald's. You want to open another McDonald's restaurant. Are you going to, keep the earnings from the company and then just use those earnings to buy another McDonald's? Or do the shareholders really actually, own that McDonald's and they just get their dividend? And the company says, hey guys, we want to sell more shares to people to open a new restaurant. And then you can decide yourself as a stockholder if you want to buy more stock to support that expansion or not. You're happy with the earnings that are coming in from the one restaurant. I think that's great. I think that makes sense. Again, it's his perspective is putting the power into the hands of the shareholders, and so I think that's wonderful. He mentions after this an example of another way of using earnings that I think he means is a positive way of doing it by reducing the goodwill. There's an example of a company reducing its goodwill down to $1 with its earnings. So in other words, it built up its balance sheet so that it doesn't have to have goodwill on it, because if you don't know what goodwill is, look it up. It's kind of baloney, in my opinion. So seeing a company reduce their goodwill to $1, they're like, our goodwill is only worth $1. But the company is actually worth a heck of a lot more, and we respect and care about our shareholders and all of the people we owe money to. Like, that's the way I see it. And then he mentions another way that earnings can be used in a good way is that when you have stocks that are clearly watered down, they have, which we've talked about before, watered down stocks is an old term for companies that don't have stuff they can liquidate and then you get your money back. That's not supported by physical assets, essentially, or even intellectual property. And so it's a way that can reduce that problem. So, whether it's overvalued real assets or goodwill, or, to make it so that the real assets a company has is more equal to the total debt and value of the company, I guess might be a way to put it. So then he makes a point that the low portion of earnings to dividend is only really worth it if earnings are way too high. So let's say earnings are super, super high for 1 year. And we know that normally this company doesn't make as much money. So in that case, he's more okay with the company retaining more of their earnings because it's that it can be averaged. Maybe that means that the company is going to be making almost nothing the next year, and then we can continue to distribute those earnings. Or if the earnings will increase its liquid assets, which he says is a rare thing. I don't know, maybe today that might refer to the ownership of Bitcoin when it's cheap, of a Bitcoin mining company. But then again, the earnings are going to be coming from selling it, so that's not a really good example. So I don't really understand that one as much necessarily, liquid assets. But anyway, maybe you can help me out and discuss it in the comments below. Next, we go through, he goes some elementary metrics regarding how PE ratios work. These days, that's one of the first things you learn about as a stockholder these days. You see it just on the plain free, Yahoo charts, your PE ratio, your earnings charts, so that brings up a good point. He didn't, they had to do all this stuff on paper. You're looking at the history of earnings, adding them up, making a chart, and then drawing a line through it, like he said earlier. I think it's so funny because even the very poorest Americans have access to this information just like that for free. It's like nothing. And having computers do it for you, if you educate yourself in this stuff. But anyway, I digress. Moving on, again, if the dividend is lower, investors should be expecting a proper amount of, if they are not distributing a certain amount, that certain amount needs to equal an equal representation of higher earnings power for the company. If we're not seeing that, what are you guys doing with my money? What you guys doing with my money? That's my money. What you doing with it? To emphasize that. He mentions here the idea of a standard dividend of stocks being 5%. I found that to be really interesting. This was not written after the 1970s, where interest rates got higher than anyone thought they could ever get, 15, 20%. In that time period, if you were buying stocks, you would want your standard dividend to be higher than that. You'd want a 40% dividend, I imagine. When you compare the risk and reward of owning these things, so I found that interesting. Obviously, 5%, but it brings up a good point. Is that so in a supposed very normal situation, 5% is like a normal number. But again, it's all just numbers, isn't it? Where do we get the idea that a 2% inflation rate is the goal from the Fed? Where does that come from? It's just a random number. It's not doesn't seem to correlate that well with many other things. Maybe GDP, but then, why not have the number be 1%? Why not 3%? Why not 5%? It's an interesting thing to think about, but I digress. So, what is an optimal normal interest rate for a civilization? I guess we'll have to talk to Ray Dalio about that. So yeah, again, unpaid dividends tend to lose value. He suggests to alter the traditional dividend viewpoint that companies should pay all earnings as a dividend unless they have shareholder approval. And I still have 2 more pages of notes here. That's really the whole chapter, like I said at the beginning, and I'm sure I'll mention it again at the end. It's just he drives it in. That point is that really, it would be fair for shareholders to make these decisions. One starred point I made here that he makes here, I starred it. A star, like a star shape. That dividends should change over time with earnings. They should go up and down. I think he's sort of implying here that having a steady dividend, that it's just the same every year no matter what, to help keep the stock price at a certain level for the shareholders, especially the people that don't have the stomach for dividends going up and down. He basically says that's kind of dumb. Stockholders should really develop a stomach for that, to be able to handle the fact that sometimes you're going to have fluctuations of that. Some years are going to be great. Some years, a car company is going to make a car and make so much money they can't handle it, and they pay it out, and then the next year they don't do as well because everybody already has that car and they don't need a new one for the next year or something. Just basic cycles like that. He's like, guys, just accept it. That would make the world a better, easier place. But instead, we live in a world still today where there's plenty of companies that they're like, our dividend is 26 cents. And you can look at the chart. It's like, boom, 26, 26, 26, 26 for like 10 years. And then they up it by like 3 cents. And then, 29, 29, 20. And it's so like the same every year, even if the company is losing money year after year. And I'm looking at some of these companies doing this. And I'm like, guys, are you crazy? Well, why? Why are you doing this? Who is... I mean, so what, you want your stock to stay in value portfolios or something like that? Like, meanwhile, you're putting your company at risk. Some of these companies are putting themselves at risk for bankruptcy by paying too much they're paying dividend they can't afford. This happens. So I see that as problematic. On the other side, he doesn't talk about that here. It must have not been a problem in this at this time, but it seems to be an additional problem today, from my perspective. All right, and then we get to the paradox I mentioned earlier in the chapter, that in this time anyway, like I mentioned, it doesn't seem true anymore. A higher dividend of percentage of earnings tends to make a company have a higher stock price. As I said, it almost seems like it's the opposite these days, that the less the dividend paid out seems to increase I might be wrong on that, but apparently this was going on then. I don't know if it's still happening. If anyone's confused about the Sylbian books example he puts in there, how it's like those, I thought he had some deep point to make. There's no deep point here. It's simply that there were a bunch of original volumes of books, and we lost some of them, or they got destroyed, and then the ones left over increased in value. That's all he's saying about that, and it doesn't relate well to this. However, that's not a paradox. The paradox for stocks is they pay out more, and then the value of the company is higher. It doesn't actually make sense. You would think logically a company that is holding more of the money it's made, that cash increases the value of the company until they pay that cash out. But it's actually it ends up being the opposite, he says, in this time. Again, in this time. I don't know if that's a continuing issue. I think maybe competition these days has maybe rectified those kinds of problems. I could be wrong. Again, please discuss anything in the comments regarding any or all of this. And yeah, he shows an example then of Atchison versus Union Pacific about paying or withholding, showing that. So then, okay, we get to the summary. And he comes up with 3 main points at the beginning of this summary. In essence, that the low dividend earnings must help increase earnings, or it isn't doing its job. If they're keeping your money, they better be using it really well, especially right now when you can take that cash money and give it to the government monthly and get a year-over-year return of 5.5% right now. That's So anyway, go dividends. Anyway, let's move on. Second point: higher dividends are always better because earnings increase. Earning increases usually don't pan out. Now. Let's just go through point by point. So usually when companies withhold too much earnings, it doesn't actually increase the earnings of the company, and you as the stockholder end up losing. You end up becoming the loser in that situation. And then we get to the point that he says basically if investors were smart, they'd demand to control what happens to the withheld earnings with scrutiny. He says he uses the word scrutiny. As it is, earnings tend to just disappear when they're withheld, and there's exceptions to this. He talks about in growth stocks later on. Believe it or not, there's always a but. Sometimes he sneaks it in there after saying the same point like 10 times in this chapter, and then he's like, but growth stocks, it's okay because they need the money to reinvest. I mean, when they first started making commercial airlines, like obviously they needed you know they need that money to buy more airplanes and increase it. If your earnings, if a company's earnings are increasing, they're doubling every year for 4 years, and they're clearly going to keep doubling for a while, then yeah, of course, keep your earnings. We it's going to make me wealthier as a stockholder, because you guys obviously know what you're doing with that money. But he says in most cases they don't know what they're doing with that money. It just goes with the wind. That's what I gather. So and also the idea that there's like a smaller amount of companies that are doing that versus companies that are already around making the full amount that they're going to be making. That's a bigger part of the market in normal conditions. Again, I feel like we're still in like this like tech bubble right now in 2023, where it's assumed that a lot of these tech companies are going to be doubling their earnings forever. That's how they seem to be priced. I've said that in some of my other videos too. So let's move on. Let's get through the last points here, if there's anything else. He makes a point that 30% of earnings should be retained for growth. If a company is going to retain earnings, I feel like he kind of sort of says that only 30% should be retained. So, okay. Again, if you have a company doubling or tripling its earnings every year and they're holding on to all their earnings, well, and doing that with it, like maybe that's okay. Like I don't know. I think his thing is that like conservatively growing companies, and that it's smart to grow conservatively. That like if a company grows too quickly, that could be bad. But then you get obviously to the point where it's like there's only so much market share, and then one company ends up dominating it, like gambling stuff on your cell phone, like DraftKings and stuff, like people betting on games. Like if you don't expand fast enough, you don't become the biggest player in the game. Eventually everyone's going to use one, right? Google, we all use Google today. They won. They if they had expanded more slowly, would they have won? Maybe not. So there's certainly arguments that can be made against Graham. Maybe in some of the later editions. Again, this is the second edition that we're using. It's supposed to be the biblical version of it. But I would bet, especially the one with Warren Buffett putting his 2 cents in, that's got to be included in this section probably. But I don't know. I haven't read it. Maybe someone else has read it and you can write about it in the comments. So let's move on. We have he mentions that 1934 to 1939 was a better period for dividends. Companies tended to pay out more of their dividends. Again, this was a period where stock prices were greatly suppressed, obviously. This was right after the Great Depression, and stocks were not popular. They were really popular in 1929, and when everybody lost everything, they were despised. And so I think that probably helped contribute to the dividend factor of right there. And it makes me, it also, again, like it's easy to draw parallels between today and 1929, where you see people chasing watered down stocks to infinity, where they don't have the assets to back it up, and if there's a downturn, it's pretty obvious that the value will be collapsing. So, we might, if we don't see a depression coming soon, maybe we will see at least a increase of the value of value stocks eventually. I mean, if you have a company paying a 10% dividend, 10 years, it's paid your entire investment off and you still own the stock for free. Like, there's so many companies out there right now with ridiculously high dividends. It makes me think that we have to be rotating into that eventually, especially with inflation being high. It might be the best time in history to be getting into value stocks. Anyway, I digress. Let's finish the chapter. Again, mentioning rapidly growing companies or industries obviously need to retain more of the earnings, especially when it's clear that like everybody's going to have a TV and nobody only the rich people have TVs, and it's like, okay, this is growing here. We got to invest a lot because wait and see what happens here. Wait till you see what happens. Certainly AI, we have yet to see the full potential of AI. We're nowhere near the full potential. That's the one obvious thing about the growth of that. Again, it might be overvalued. We don't know how long it's going to take before it really starts dominating. But I digress to move on. To increase distributions, in 1936, Congress actually imposed a tax depending on how much a company retained of their earnings, going from 7 to 27% of the retained earnings. And so he describes in this period that people were violently criticizing this, and so it was pretty quickly reduced to a total of 2.5% in 1938. But he wanted to discuss this, and he says, at the end of all of this, he says, well, companies could have done A, B, and C, and they would have been all right. They could have they could have navigated this. Like, he didn't necessarily see it. He didn't see it as something unsurmountable. But the people didn't make certain points that he makes in arguing against it. The biggest criticisms were that well, first of all, companies can lose capital. They can lose the value of their inventory can go down. They can have lots of situations where it's not fair to tax the earnings of a company 27%, just because they didn't pay it out to the shareholders. So from Congress's perspective, they were trying to actually get more taxes. Simply, they were trying to influence companies to pay out more dividends so that they could collect more money on those dividends being distributed. It wasn't to. I don't think it was to. It was a punitive tax for withholding earnings, which, on the surface you would think that Graham would support, but he's actually very much against it, because he says that it adds layers of taxes on corporations, and that using that penalty tax on companies is actually worse for the small shareholder, because the small shareholder doesn't necessarily have to pay that much taxes himself, and he's the owner of this company, and you're taking this earning power away from this company. Well, this guy, it actually hurts the smaller shareholders more. I found that a very interesting point. And he says that people weren't making that point, but he wanted to make that point. But yeah, Congress, it was they wanted to have this tax to increase taxes they could get and supposedly protect shareholders by having those by kind of forcing companies to pay out their dividends. So apparently this was a contentious issue in that time of, where's all this money going that you guys are earning? Like, why aren't you giving it to the shareholders? So that was on people's minds apparently in this time period. But that covers all of my notes from this chapter. Excellent chapter, just to really grasp the value of earnings, mostly the value of undistributed earnings. Yeah, again, like, where is that money going? So the final conclusion, again, as I stated at the beginning of the video, the best scenario is when stockholders are the ones that, with their votes, based on how many shares they have, should choose if any earnings are retained. And they should do so with scrutiny. Like, really? You don't want to pay us all of the dividend? What you going to do with that money? Putting that in the hands of the stockholders. Not to the insiders, not to the management, not to the corporation, is like what he says is this, it's not some distant separate entity. The whole idea of owning shares, your share, literally, of the companies, that you are in fact the owner, and you really should have a say on what happens to the earnings, And again, just to reiterate, he basically reiterates the same point 1,000 times in this chapter, just to really hammer it in that, if a company is making money, if it's making earnings, my biggest takeaway from it is you as an investor, you as a stockholder, should know where that money is going. Is it disappearing into the pockets of the insiders, into the, higher salaries? Is it, is it just poof, all gone? Oh yeah, we earned lots of money this year. Yeah, no, and here's a little bit of that money, shareholders. You can have a little bit. Like, no, I'm the owner. I own the earnings, and maybe I'll give some back to you so you can, make more money for me as the stockholder. So anyway, so that's the perspective. That's the whole point of this chapter. Beautiful chapter, beautifully written. Please discuss anything and everything in the comment section below. That was chapter 29, the dividend factor in common stock analysis. Thank you for tuning in. Rob's Child.